Berkshire Hathaway Incorporated, under the leadership of Warren Buffett and Charlie Munger, has become a financial behemoth, delivering exceptional returns to its shareholders. The success of Berkshire Hathaway is often attributed to the savvy investment strategies and business acumen of Buffett and Munger. However, the full story involves a complex interplay of strategic decisions, philosophical insights, and unique management practices that have propelled the company to its current stature. Number 5. The early days. Berkshire Hathaway's origins can be traced to a textile manufacturing firm founded in 1839 in New Bedford, Massachusetts, under the name Hathaway Manufacturing Company. Over the subsequent decades, the company evolved, merging with other textile operations and rebranding as Berkshire Fine Spinning Associates in 1929, following a merger with Berkshire Cotton Manufacturing Company. Despite various changes in ownership and market fluctuations, the textile industry faced persistent challenges, particularly in the mid-20th century as competition from overseas and shifts in consumer preferences eroded profitability. In 1962, Warren Buffett, then a young investor with a keen eye for undervalued assets, began acquiring shares in Berkshire Hathaway, recognizing the company's potential for substantial financial improvement despite its struggling textile operations. By 1965, Buffett had gained control of the company and, along with his partner, Charlie Munger, began a transformative strategy shift. They gradually moved away from the textile sector, focusing instead on acquiring undervalued companies and investing in diverse industries. This strategic pivot allowed Berkshire Hathaway to diversify its holdings and leverage its capital effectively. Buffett and Munger's innovative investment approach, marked by disciplined financial management and a commitment to long-term value creation, redefined Berkshire Hathaway from a struggling textile enterprise into one of the world's most influential and successful conglomerates, encompassing a wide array of industries from insurance to retail and energy. Number 4. Investment philosophy. Central to Berkshire Hathaway's monumental success is its distinctive and rigorous investment philosophy, pioneered by Warren Buffett and Charlie Munger. This philosophy, deeply rooted in the principles of value investing, revolves around the meticulous identification and acquisition of undervalued companies that exhibit robust fundamentals. Buffett and Munger prioritize investing in businesses that possess what they term durable competitive advantages, a term they use to describe companies with intrinsic strengths that enable them to sustain long-term profitability and fend off competitors. Such advantages may include strong brand identity, proprietary technologies, cost advantages, or exclusive access to the best natural resources. In addition to these competitive advantages, Buffett and Munger emphasize the importance of competent, trustworthy management teams who are adept at navigating industry challenges and are aligned with shareholder interests. Their investment strategy also places a premium on businesses with the potential for sustained growth, preferring those with predictable earnings and a clear trajectory for expansion. This approach is complemented by a thorough due diligence process, wherein they meticulously analyze financial statements, industry trends, and management quality before making investment decisions. By adhering to this disciplined methodology, Berkshire Hathaway has built a diversified portfolio of companies that not only provide substantial returns, but also reinforce the conglomerate's long-term stability and growth. This value investing framework has been instrumental in transforming Berkshire Hathaway from a struggling textile manufacturer into a global financial powerhouse. Number 3. The role of capital allocation. A pivotal component of Berkshire Hathaway's unparalleled success is its highly refined capital allocation strategy, expertly executed by Warren Buffett and Charlie Munger. This strategy involves a sophisticated approach to deploying capital in a manner that maximizes long-term value creation rather than merely focusing on reinvestment within the core textile business, which was its initial focus. Instead, Buffett and Munger have cultivated a disciplined and opportunistic approach to capital allocation, prioritizing the deployment of surplus funds into high-return investment opportunities. Their process begins with a comprehensive assessment of available capital, identifying the most compelling investment prospects across a broad spectrum of industries. They seek out businesses that offer attractive valuations, possess strong competitive positions, and demonstrate the potential for robust, long-term growth. Rather than confining investments to traditional avenues such as expanding existing operations, Buffett and Munger actively pursue opportunities to acquire entire companies or substantial equity stakes in established firms. This strategy allows them to leverage Berkshire Hathaway's financial strength to gain control of or influence over high-quality businesses, enhancing the conglomerate's overall value proposition. The acquisitions are meticulously evaluated for their ability to generate sustainable cash flows, deliver consistent returns, and align with Berkshire's investment principles. Furthermore, Buffett and Munger ensure that the acquired companies are managed in a manner that preserves and amplifies their inherent value, often providing a level of operational autonomy while maintaining oversight to ensure alignment with Berkshire's overarching goals. This capital allocation acumen has been instrumental in enabling Berkshire Hathaway to amass a diverse and lucrative portfolio, including prominent investments in insurance, utilities, consumer goods, and technology. The strategic deployment of capital not only contributes to the conglomerate's growth, but also reinforces its resilience in navigating economic fluctuations, thereby solidifying Berkshire Hathaway's position as a leading global investment entity. Number 2, the power of patience. Warren Buffett and Charlie Munger's extraordinary success is rooted in their unwavering commitment to patience and a long-term investment perspective, a cornerstone of Berkshire Hathaway's strategy. Rather than engaging in short-term speculation or attempting to time the market, practices that are often influenced by volatile market sentiment, they adopt a more measured approach. This involves holding investments for extended periods, often indefinitely, allowing time for the intrinsic value of their acquisitions to manifest fully. Buffett famously refers to this as buying to hold forever, reflecting their belief that true value emerges over decades, not quarters. This philosophy contrasts sharply with the short-termism that dominates much of modern investing, where quick returns and reactive strategies can lead to suboptimal outcomes. Their long-term outlook is especially beneficial when it comes to harnessing the power of compounding. By maintaining their positions in high-quality businesses with strong fundamentals, Berkshire Hathaway capitalizes on the exponential growth that compounding returns deliver over time. As earnings are reinvested and the businesses expand, the overall value of Berkshire's portfolio grows, often at an accelerating pace. This approach also reduces transaction costs, taxes, and the friction associated with frequent trading, further enhancing returns. Buffett and Munger also understand that market fluctuations are inevitable, and they resist the temptation to respond to short-term price movements or market hysteria. Instead, they focus on the underlying business performance and the long-term prospects of the companies in which they invest. This patience allows them to ride out periods of market downturns without panic selling and to take advantage of market corrections by acquiring additional shares at attractive prices when others are selling in fear. Their discipline in adhering to this long-term strategy has enabled Berkshire Hathaway to avoid the pitfalls of reactive investing, ensuring steady and sustainable growth for both the company and its shareholders over many decades. This patient, time-tested approach is a hallmark of their investing genius, contributing significantly to Berkshire Hathaway's reputation as one of the most successful investment firms in history. Number 1, management and culture. A defining element of Berkshire Hathaway's remarkable success is its distinctive corporate culture, meticulously cultivated by Warren Buffett and Charlie Munger. At the core of this culture is a deep trust in the competence and integrity of the managers who lead the conglomerate's many subsidiary companies. Rather than imposing a centralized, top-down management structure, Buffett and Munger have embraced a highly decentralized approach. They give the leaders of acquired companies significant autonomy to run their operations as they see fit, a management philosophy that respects the expertise and experience of these executives. This hands-off approach not only empowers managers but also preserves the entrepreneurial spirit of the businesses Berkshire acquires, allowing them to thrive under their own vision and direction without undue interference from the parent company. Buffett and Munger's philosophy stems from their belief that talented managers, when left to their own devices, will be more innovative, motivated, and efficient than they would be under a micromanaged system. Instead of closely monitoring day-to-day operations, they focus on selecting businesses led by individuals who possess strong operational expertise, impeccable judgment, and a deep understanding of their respective industries. Once a company becomes part of Berkshire Hathaway, the managers are expected to continue operating as if they still own the company, with full responsibility for its success or failure. This level of trust fosters a sense of ownership and pride among the managers, further driving the success of these businesses. This decentralized management style also reduces bureaucratic overhead, allowing Berkshire Hathaway to operate as a lean and efficient conglomerate despite its vast and diverse portfolio. Each business within the group is given the freedom to innovate, grow, and respond quickly to market conditions without the delays and inefficiencies that can come with centralized decision-making. Moreover, the autonomy granted to managers creates an environment of accountability. They are directly responsible for their business results and are incentivized to focus on long-term value creation rather than short-term financial engineering or meeting arbitrary corporate targets. If you enjoyed this video, consider checking out our other content.